Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
But you can see here, they're looking at the realized vol. We've been at about, this on a 20-day average, a 22-day trading average, which I use 22 trading days because that is a good encapsulation of the last of a full trading month. Every trading month, not every trading month, but most trading months have about 21 and a half or 22 trading days in them. So I look at realized vol on a rolling monthly basis, if you will, in terms of business days. So you can see here from this euro, we've obviously been in a bit of a downtrend. A lot of this goes to when it's not necessarily that the Greek crisis became an issue, but it's more important when we decide to start paying attention to it, I think, is what really helped exacerbate and drive this sell down. Excuse me again. So you see here the market putting a series of lower highs and lower lows. We're now trying to form a bottoming process. As a result of this compression here, we see that it realized vol really compressed by 25 or 30% off of these highs here of 150 to 160 pips a day. We're now sporting up until Sunday, the 22-day average about 125 pips a day. So that's a real compression in implied in realized volatility in these markets. Looking across at other currency crosses here, I think this is something that the cross you really want to pay attention to. The euro Aussie, for as much issues that are out there with the U.S. dollar, I think the euro Aussie is going to set up a couple of really nice spots. And we've had a little bit of a rally in this market with the euro round against the Aussie, but this has been a peach of a trade that doesn't quite get as much attention, but these positions can still be created synthetically using your ISE options and so forth. But again, the same dynamic we talked about. Look at the ATR average true range being up near 200 pips a day of this. We've now compressed back being near 135. So, I expect that to change, and I'll go over some strategies on how I'm playing it and how you may want to play it as well. Again, this is, read the disclaimers, read the disclosures. I'm sharing you with my perspective, but we all have different thresholds for risk. We all have a different understanding of how these markets play out and how we want to gain our exposure to them. Looking at the Euro Swiss, this is something that, again, the Swiss National Bank, SNB, had firmly protected this 146 level for about 3 weeks in here. So I wouldn't pay too much attention to this cross other than it's just interesting to see some of these European crosses in all the dynamics and almost the race to zero, if you will, and who can whether de facto or formally devalue their currency the fastest to really negate a lot of their debt. Looking over at the euro pound, we've seen actually a nice bounce in the euro pound in the last day and a half. I think that's setting up as a decent short, but the euro here, which was on a pretty robust up move. I need to get this little. There we go. We see the euro pound on a robust up move, looking like it was going to rally to parity. All of a sudden, we hit December, and we get a nice little sell down here, and really, I think these non-major crosses can provide some really nice opportunities because they're not as widely participated in, and I think that they can trade a little bit cleaner to technical sometimes than can some of the other major crosses. But nonetheless, with the currency space in general, to me, along with some of the ag products like sugar, have been a better place to trade. And again, the class we have coming up is, how to survive a volatility drought. And how to survive a volatility drought is pay particular attention to what implied vol is doing, to how realized vol is acting, certain metrics, certain technical metrics which can indicate that a crossover or that a change in sentiment in terms of volatility has taken place. But just looking at this right now, I think you want to be selective in terms of it's not just getting along a European basket, or being short a European basket of currencies. It's really being selective in terms of which crosses you decide to play. This is Euro Yen. This bad boy has had its own little metric behind it. This gets more attention than a lot of other non-traditional crosses out there. I know Gartman likes to talk a lot about this in his newsletter, as well as a number of other currency followers pay very close attention to the Euro Yen. This is one that you can do a nice overlay going back to the fall of 2008 in terms of when the carry trades came undone and you saw a lot of flight back into the yen. This bad boy has a lot of movement to it. And I think if you look at just the fluidity and the harmony of this euro yen chart, juxtaposed to, even the euro chart right here, you can see that there's just more flow in the euro yen than there even is in the euro USD. And I think that's something that as you look for products to trade, okay, and you look at the S&P, which is in, a 5-point grind fest every day, or you look at, the euro yen, which actually has some trend, some follow through for you Elliott wave people out there. There's a little bit of flow. There's some nice flow here, some reflex moves back and forth again. There's opportunity for both the bulls and the bears to make money in this cross. And as a trader, as a proprietary trader, that's something that I look for. And as a consultant to other traders and hedge funds out there and other exchanges, it's products that display this type of rhythm and harmony that you want to be involved in. So now, using this European debt crisis, using what Fotis has talked about as a backdrop, those markets which respond to these news events, those markets which respond to technicals, are where we really want to position ourselves. Looking forward to another cross here, we have the British pound US dollar. Again, I think that this 155 levels, I think this is a classic case in this bad boy that you want to be almost like long a short month call and long a back month put. I think that you can set up a really interesting gamma profile in a portfolio by constructing something like that. In the sense that I think shorter term, you can get a nice bounce, scalp around that, and still hold on to a longer term position with the back month put, and just do some of your own machinations from there. Again, I'm hitting a lot of points here, and I put my contact info up, I believe, in the beginning of the initial slide, and I'll have it up at the end. I'm trying to hit a lot of good points in the time frame that we have, so by all means, if some stuff I'm saying here, this is recorded, feel free to ask me some questions about what I'm discussing. Again, continuing on here, we're talking about the U.S. dollar, Japanese yen. Again, another, this is not a bad currency cross. We saw some grind in here. I know that I was actually long premium at this point in time, and watched Theta just beat me up every day as I was sitting long a straddle at this point in time. But that ended up reconciling itself to the good, and we got some nice movement here, and we're getting a little bit of a pullback in this spot. So I think that the YUK, the YUK, is a very nice ISE hazard, allows you to take on some exposure to this respective market here, because the yen, while we are seeing some more isolated Japanese geopolitical focus, I lived in Japan for close to 5 years, worked at the U.S. Embassy there, so I have my heart in trading the yen. I always have special feelings towards the Japanese yen when it comes to trading, whether long or short, depending how patriotic I am that day. It's something that definitely has some decent range in it right now, and I think that this 93 level is a nice spot to hold, and conversely, I think if we do pull down to 91 in here as well, that'll also provide a nice reaction bounce, which for you volatility traders can be a good spot to maneuver around a respective position. And I think the no currency conversation is complete without bringing gold into the picture. Now, this was again taken Saturday. Gold's backed off about $10. It did get a little bit of an overnight spike up to like 11. I want to say 1170 on this June contract here for the gold futures. But nonetheless, though, despite what's taking place in Europe, despite what's taking place in the U.S. and some of the budget concerns which can weigh in and out, I think that gold becomes a natural place that when you look at countries imploding, when you look at some of the sovereign debt issues taking place out there, gold's not a bad hedge for that. We've seen once before where how do you weigh the balance? Gold came under a lot of pressure in the fall of 2008 when really some major deflation risk took over. I think that the dynamic this time could be a little bit different, that even if some deflation concerns do creep in, I think that the overall net store value play can be quite nice. And even if you set up, gold in terms of yen, gold in terms of euros, gold in terms of British pounds, more than just U.S. dollars, you really can mitigate a lot of that dollar risk and construct a more non-traditional portfolio that can insulate you from some of that can potentially insulate you from some of the geopolitical risks which exist out there.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.